Rewritten. January 2026. For a few hours, the world didn't panic. It did something more revealing. It paused, and recalculated. Reports began circulating that U.S. forces had taken custody of Venezuela's president. At first, nothing was confirmed. No press conference. No clean statement. Just fragments, leaks, briefings, unnamed officials, and headlines hedged with words like allegedly and reportedly. But that didn't matter. In modern systems, belief moves faster than proof. Trading desks reacted before diplomats spoke. Energy prices jumped before statements were written. Secure phones lit up across capitals, not because anyone knew the full truth, but because the claim itself was plausible enough to demand action. That was the signal. For decades, the global order has rested on a quiet assumption: the dollar system is enforced through access, not force. Sanctions. Banking restrictions. Asset freezes. Tools that look administrative, even when they function like weapons. But the moment markets began behaving as if direct force had entered the equation, the question changed. It was no longer, can this happen? It became, what does it mean if it can? Because financial systems don't run on morality or legality. They run on expectations, and fear of being late. And in those hours, the fear wasn't really about Venezuela. It was about precedent. If defying the dollar system could now carry physical consequences, not just financial ones, then alignment was no longer only an economic choice. It was a security calculation. That is a different world. This isn't financial advice. It's an examination of how modern power reacts when enforcement stops being implied and becomes visible. And to understand why that reaction was so fast, you have to understand why Venezuela isn't just another country in this story. It's a pressure point. To understand why the January shock mattered, you have to understand what Venezuela represents. Not politically. Not ideologically. Structurally. Venezuela holds the largest proven oil reserves on Earth, roughly 303 billion barrels. More than Saudi Arabia. More than Russia. More than Iraq, Iran, or Kuwait. At current prices, that oil represents tens of trillions of dollars sitting underground in one country. That fact alone makes Venezuela different. For most of the last century, Venezuela was deeply embedded in the petrodollar system. Its oil flowed to U.S. refineries. Payments arrived in dollars. Those dollars recycled back into U.S. assets, treasuries, goods, defense spending. It was a closed loop. Venezuela received stable revenue. The United States received cheap energy and permanent global demand for its currency. This wasn't ideology. It was plumbing. Venezuela wasn't just compliant, it was influential. As a founding member of OPEC, it helped shape pricing norms and supply coordination. When Venezuela priced oil in dollars, it reinforced the system for everyone else. That's why Venezuela became a stress test. If the dollar system could tolerate any major producer leaving, it should tolerate Venezuela. If it could not tolerate Venezuela leaving, then no one was truly optional. That question, whether exit was possible at scale, sat quietly beneath the surface for decades. Until someone began testing it. And started removing Venezuela from the system. For years, Venezuela's conflict with the dollar system could still be framed as politics. Leadership. Rhetoric. Ideology. Sanctions changed that. Because sanctions are not a warning mechanism. They are a switch. When the United States sanctioned Venezuela, it didn't just apply pressure. It removed access. Access to dollar clearing. Access to shipping insurance. Access to capital markets. Access to equipment, parts, and maintenance. That distinction matters. Pressure leaves choices. Expulsion removes them. By 2017, Venezuela wasn't being nudged toward compliance. It was being pushed out of the dollar-based system entirely. U.S. companies were barred from buying Venezuelan oil, eliminating its largest customer almost overnight. Dollar accounts were frozen, making billions inaccessible with a keystroke. Insurers were prohibited from covering Venezuelan tankers, turning legal shipping into a liability. Suppliers were cut off, and oil infrastructure began degrading immediately. Oil production collapsed, not because oil disappeared, but because participation disappeared. At that point, Venezuela faced a binary reality. Return to the dollar system on U.S. terms. Or survive outside it. There was no third option. This is where most analyses go wrong. Sanctions didn't fail because Venezuela resisted. They failed because sanctions forced adaptation. When you remove a country from the dominant system, it doesn't stop trading. It reroutes. Venezuela didn't choose de-dollarization as a strategy. It adopted it as a survival response. Oil flowed to China in yuan. To India in rupees. To Russia through barter and workarounds. Not because those arrangements were efficient. But because they were available. And something else happened at the same time. Other countries were watching. Not Venezuela's suffering, but Venezuela's functionality. Despite economic collapse, oil kept moving. Trade continued. The state survived. The lesson wasn't that sanctions are painful. Everyone already knew that. The lesson was that the dollar system is optional, if a country is willing to endure exclusion. That realization didn't stay in Caracas. It moved quietly through foreign ministries. Through central banks. Through energy ministries. If sanctions are the cost of exit, the real question becomes: is that cost temporary, or permanent? Once countries began asking that, the system changed. Because a reserve currency depends on belief. Belief that access is stable. Belief that participation is voluntary. Belief that exit is unnecessary. Sanctions broke all three. They revealed that participation is conditional. And once that becomes visible, redundancy becomes rational. That is why Venezuela stopped being seen as a problem country. And started becoming a reference case. Not a success story. A proof of concept. And once a proof of concept exists, even rumors of enforcement can move markets. Which is where the January moment enters the picture. Not emotionally. Structurally. When perception became the event. In early January 2026, something unusual happened. There was no announcement. No speech. No confirmed operation. Instead, a claim began circulating. No attribution. No footage. No official confirmation. Just fragments moving through trading terminals, diplomatic channels, and encrypted messaging groups. The claim was simple and destabilizing. That U.S. Special Forces had detained Venezuela's president. At first, it looked like noise. The kind that usually fades. This time, it didn't. Within hours, markets reacted as if the claim were real. Oil futures jumped in thin electronic trading. Risk premiums widened. Energy insurers quietly repriced coverage. Emerging market currencies sold off. Governments moved before facts were established. Latin American foreign ministries demanded clarification. China's foreign ministry called an unscheduled briefing. Russia requested an emergency session of the UN Security Council. Across central banks, energy ministries, and sovereign funds, the same question surfaced. If this can happen to Venezuela, even as a rumor, who is next? Now, an important clarification. There has been no public confirmation that such an operation occurred. No White House statement. No Pentagon briefing. No independent verification. That uncertainty is the point. Because for several hours, the global system behaved as if the claim were plausible. And in markets and geopolitics, plausibility is enough. Traders don't wait for proof. They hedge. Governments don't wait for certainty. They model worst-case outcomes. A reserve manager deciding whether to roll treasury exposure doesn't ask whether a rumor is true. They ask what happens if it ever is. In that window, measured in hours, not days, something irreversible happened. The enforcement logic of the dollar system became visible. Not inferred. Not debated. Seen. The takeaway was not that Venezuela had been invaded. The takeaway was that enforcing dollar dominance through force now felt believable. And once participation in a financial system appears to carry security risk, it stops being neutral. Those calculations, once made, don't easily reverse. January 2026 did not prove that the dollar system is enforced militarily. It proved that the world believes it might be. And belief, at scale, is enough to reprice risk, reshape alliances, and accelerate exits that were already being quietly prepared. That is why the January moment mattered. Not as a headline. As a signal. Markets didn't move because Venezuela mattered emotionally. They moved because specific people, in specific roles, had to make decisions under uncertainty, and delay itself became risk. An oil trader didn't ask whether the report was confirmed. They asked whether a supply shock was now plausible. An insurer didn't ask whether the operation happened. They asked whether political risk had just become asymmetric. A central bank didn't ask whether the rumor was true. They asked whether rolling dollar exposure still carried only financial risk, or something more. Those are different questions. And once they were asked, behavior changed. Within hours, energy traders priced a security premium into oil, not because barrels were missing, but because enforcement risk had entered the equation. Shipping insurers quietly adjusted coverage thresholds for routes connected to sanctioned or semi-sanctioned producers. Not publicly. Operationally. Sovereign wealth funds didn't issue statements. They opened spreadsheets. Scenario models that once lived in footnotes were pulled forward. What if dollar exit is treated as a security issue? What if access risk is no longer theoretical? What if compliance buys time, but not safety? This was the threshold moment. Nothing dramatic happened on screens. But inside institutions, assumptions changed. Once enough decision-makers reached the same conclusion independently, markets moved without needing headlines. Oil didn't rise because Venezuela lost production. It rose because the cost of non-alignment was repriced. Currencies didn't weaken because fundamentals collapsed overnight. They weakened because optionality narrowed. By the time price moves became visible, the decision had already been made. And here's the critical point. Nothing that moved in January depended on confirmation. It depended on plausibility. Once enforcement risk entered models, even as a tail event, it stopped being ignorable. That's the difference between a rumor and a catalyst. A rumor fades. A catalyst changes incentives. And incentives, once adjusted, don't reset on their own. The world didn't wait to find out what happened in Venezuela. It moved as if the answer might no longer matter. Because the risk had already changed. And once risk changes, behavior follows. Quietly. Incrementally. Irreversibly. At first, the response looked localized. Venezuela. Oil markets. A handful of currencies. That is how systemic shifts always begin, appearing specific, manageable, and isolated. But the dollar system does not operate in compartments. It operates through links. And once one link is perceived as coercive, every adjacent link absorbs stress. The January moment didn't just affect Venezuela. It altered how participation in the dollar system itself was evaluated. Before, risk was financial. After, it was conditional. That distinction matters. Because financial risk can be priced. Conditional risk cannot. A bond trader can hedge interest rates. An importer can hedge currency exposure. An insurer can model loss probabilities. But no model can reliably price the risk of access being withdrawn. That is the pressure point. Once access becomes uncertain, even hypothetically, actors stop optimizing. They start insulating. That shift is subtle, but decisive. Energy exporters began reconsidering settlement terms, not to abandon the dollar overnight, but to reduce dependence at the margin. Central banks shortened treasury duration. Not because they expected default, but because liquidity mattered more than yield. Shipping firms rewrote routing assumptions. Not because sanctions expanded, but because enforcement thresholds had become unpredictable. None of this required coordination. It didn't need announcements. It didn't need ideology. It only required alignment of incentives. When enough institutions independently reach the same conclusion, behavior synchronizes without instruction. This is how fragmentation begins. Not through revolt. Through redundancy. Countries didn't rush to exit the dollar system. They began building parallel paths alongside it. Alternate settlement currencies. Bilateral clearing agreements. Commodity-linked payment structures. Not because the dollar stopped working, but because relying on one system now carried asymmetric downside. And once redundancy exists, it gets used. That is the part policymakers consistently underestimate. Systems don't return to single points of dependence after alternatives are built. They diversify further. What had been theoretical hedges became operational practices. What had been contingency planning became routine execution. This wasn't panic. It was adaptation. And adaptation, once underway, doesn't reverse simply because volatility subsides. Because the lesson of January wasn't about Venezuela. It was about visibility. The moment enforcement became imaginable, neutrality disappeared. And when neutrality disappears, alignment becomes a liability. That is why this couldn't stay contained. Not because markets overreacted. But because systems remembered something they had been trying to forget. Dependence is efficient. Until it isn't. And once that realization spreads, the system doesn't break. It reorganizes. Quietly. Permanently. After January, no country announced a dramatic break. There were no speeches declaring the end of the dollar. No flags raised. No treaties torn up. That's not how realignment happens. It happens quietly, through adjustments that look technical until they accumulate. The first movement came from energy exporters already operating at the edge of the system. Countries that had lived with sanctions, partial exclusion, or political pressure understood the signal immediately. Russia expanded oil for goods arrangements. Iran deepened yuan settlement with China. Venezuela continued routing trade through non-dollar channels, not as protest, but as default. These weren't symbolic acts. They were logistical decisions. But the more telling shift came from countries that had not been targeted. Mid-sized exporters. Strategic swing states. Countries that still had full access, and wanted to keep it. They didn't exit. They diversified. Saudi Arabia didn't abandon the dollar. It tested alternatives. A portion of oil sales to China moved into yuan settlement. Small at first. Framed as efficiency. Positioned as optional. That framing mattered. Because once an alternative is used without consequence, it becomes precedent. And precedent is contagious. The UAE explored bilateral settlement frameworks. Brazil and China expanded direct currency swaps. India increased rupee-based trade with energy suppliers. None of these moves made headlines in isolation. Together, they changed the topology of the system. This is the moment exit stops looking ideological, and starts looking prudent. Not because the dollar collapsed, but because dependence no longer looked symmetrical. For decades, dollar participation carried upside and safety. After January, it carried upside and exposure. That's a different calculation. Central banks responded the same way portfolio managers do under uncertainty. They reduced concentration. Treasury holdings weren't dumped. They were trimmed. New reserves weren't allocated exclusively to dollars. They were split. Gold purchases increased. Duration shortened. Liquidity preference shifted. No one wanted to be first out. But no one wanted to be last, either. This is how alignment pressure works. The more countries quietly prepare alternatives, the more costly non-preparation becomes. At a certain point, staying fully exposed stops being loyalty. It starts looking like negligence. And that's when exits accelerate, not because of politics, but because of professional obligation. No finance minister wants to explain why they ignored an obvious hedge. No central banker wants to justify single-point failure. January didn't force anyone out of the dollar system. It changed the burden of proof. From "Why would we leave?" to "Why wouldn't we prepare?" And once that question flips, momentum takes over. Not loudly. Not suddenly. But steadily. Because systems don't collapse when confidence disappears. They shift when alternatives feel safer. And by February, alternatives no longer felt theoretical. They felt usable. Which brings us to the part most people underestimate. What happens to the dollar itself when demand erodes quietly rather than collapses visibly? Reserve currencies don't collapse. They thin. There is no announcement. No deadline. No single breaking point. What disappears first is not value, but demand. After January, nothing dramatic happened to the dollar. It continued to trade. It continued to settle contracts. It remained liquid. That's what makes erosion hard to see. The change showed up in decisions that never make headlines. A central bank allocating new reserves chose not to add dollars. An energy importer accepted non-dollar settlement where it hadn't before. A trade finance desk widened hedging assumptions. Each decision was small. Together, they mattered. Because reserve currency strength isn't measured by usage. It's measured by incremental demand. When fewer transactions require dollars, the system doesn't break. It adapts downward. Treasuries illustrate this perfectly. There was no sell-off. There didn't need to be. Foreign buyers simply became less enthusiastic. New issuance required slightly higher yields. Maturities shortened. Auction tails lengthened. Nothing alarming in isolation. But persistent. This is how pressure builds without volatility. The dollar didn't weaken because confidence vanished. It weakened because redundancy spread. And redundancy changes pricing power. When alternatives exist, the dominant system has to compete. Compete on yield. On terms. On predictability. That competition raises costs. Not immediately. Incrementally. Import prices edge higher. Energy contracts price in insurance. Funding becomes marginally more expensive. None of this feels like crisis. It feels like friction. But friction accumulates. And unlike panic, friction doesn't reverse when headlines fade. This is where reserve status quietly becomes expensive. Not to hold, but to maintain. Because supporting a currency in a world with alternatives requires concessions. Higher interest rates to attract buyers. Policy restraint to preserve credibility. Or intervention to stabilize flows. Each option carries trade-offs. And those trade-offs don't disappear just because markets stabilize. By the time erosion becomes visible in exchange rates or inflation data, the underlying shift is already advanced. That's why the January moment mattered. Not because it caused immediate weakness, but because it accelerated a process that only moves one way once it starts. Currencies don't lose dominance in crashes. They lose it in calm periods. When no one feels urgency. And everyone quietly prepares. Which leads to the constraint the system now faces. Because as dollar demand thins, something else has to absorb the adjustment. And that adjustment never stays abstract. When a reserve currency weakens, the damage doesn't arrive as a headline. It arrives as pressure. Pressure that moves through prices, budgets, and policy choices until it reaches people who never opted into the system in the first place. That's where erosion becomes tangible. The first place it appears is trade. When fewer transactions require dollars, demand softens. When demand softens, purchasing power slips. Imports don't suddenly become unaffordable. They become incrementally more expensive. Energy contracts settle with added risk premiums. Industrial inputs cost slightly more. Consumer goods edge higher, not because of shortages, but because currency friction has entered pricing. That friction compounds. A 10% currency adjustment doesn't raise prices 10%. It ripples. Transportation costs rise. Insurance costs widen. Hedging costs embed into final pricing. What looks like a modest currency move becomes a persistent cost of living increase. The second place it surfaces is policy. As dollar demand thins, financing becomes more sensitive. Treasury issuance still clears, but at higher yields. Not because markets panic, but because they require compensation. That forces trade-offs. Higher rates support the currency, but slow growth. Lower rates support growth, but weaken the currency further. There is no neutral setting. Every choice redistributes cost. The third place it appears is political. Because inflation doesn't arrive evenly. And restraint doesn't land evenly either. Households feel price pressure first. Governments feel financing pressure second. Institutions adjust last. That sequence matters. Because once inflation becomes visible while growth slows, options narrow. Support the currency aggressively and absorb economic slowdown. Or accommodate inflation and erode purchasing power. Neither choice restores the prior equilibrium. They only manage decline differently. This is the part most people miss. Reserve status doesn't fail when confidence disappears. It fails when supporting it becomes socially expensive. When maintaining dominance requires trade-offs that voters feel. Governments begin to compromise quietly. Subsidies expand. Controls are discussed. Interventions normalize. Not as emergency measures, but as management tools. By the time these pressures are debated publicly, they've already shaped behavior. Spending patterns change. Savings behavior shifts. Risk tolerance declines. The system adapts downward. Not through collapse. Through compression. And compression always lands somewhere specific. Which is why the final question is not whether the dollar survives. It's who absorbs the adjustment. Because when reserve demand fades quietly, the cost doesn't disappear. It migrates. And the direction it moves next is not random. When systems lose privilege, they don't lose it evenly. They redistribute the cost. In the case of a weakening reserve currency, that redistribution follows a familiar path, one that favors institutions with flexibility and burdens those without it. The first to adapt are the largest actors. Multinational firms shift invoicing currencies. Financial institutions widen margins. Governments adjust policy frameworks. They move early because they can. The cost doesn't settle there. It passes through. Households don't choose settlement currencies. They don't hedge trade flows. They don't renegotiate import contracts. They receive the outcome. When prices rise gradually, wages lag. When rates rise incrementally, debt costs compound. When policy tightens, mobility narrows. None of this feels dramatic. It feels like pressure that never fully lifts. This is where the adjustment concentrates. Not on balance sheets that can diversify, but on incomes that cannot. Savings lose purchasing power. Borrowing becomes more expensive. Essential goods consume a larger share of budgets. The effect isn't equal. It's asymmetric. Those with assets reprice. Those without absorb. That's not a moral statement. It's a structural one. Reserve currency privilege masked this imbalance for decades. Cheap imports. Low financing costs. Externalized inflation. As demand thins, those advantages recede. And when they do, the economy doesn't reset. It relevels. That releveling isn't catastrophic. But it is permanent. Standards of living don't fall overnight. They adjust downward over time. Expectations lag reality. Then catch up. This is why the erosion phase matters more than any single shock. Once costs are embedded, in prices, contracts, and policy, they don't reverse with sentiment. They require trade-offs to unwind. And those trade-offs rarely favor the median household. This is the quiet end of dominance. Not marked by crisis, but by normalization of constraints. What was once subsidized becomes priced. What was once assumed becomes conditional. And the adjustment continues until the system reflects its new position. Which brings us to the final point. Because once this process starts, it doesn't ask permission to finish. And it doesn't wait for consensus. It moves until the imbalance is absorbed. By someone. Somewhere. Which is why the last question isn't whether the dollar remains important. It's whether the cost of keeping it dominant is still politically tolerable. And that question has only a limited window before it answers itself.